Hey guys, Mr. Flanagan here. Just a quick note before we get started. If you hear weird dog or animal sounds, that's our dog Hera zooming around the backyard and just generally being a spaz, getting the zoomies right now. If you also hear some kitchen sounds, my wife is baking cookies. Sorry, you don't get any, but that's what's going on if you hear a mixer or something like that. So fractional reserve banking. This is the Federal Reserve right here, and we'll get into that over the next few days. But fractional reserve banking is something that this ominous looking building, the Fed, has control over. So what is fractional reserve banking? It's basically a scenario where every time a customer comes into a bank, specifically a customer comes into the bank, a percentage of what the customer deposits must be held onto by the bank. They cannot loan out that specific percentage. Any dollar amount beyond that percentage can be loaned out. And that's basically how banks make money. So anytime a customer comes in, they put down some cash or a paycheck, the bank has to be thinking this. Can't touch this. Can't touch this. So why does this exist? Like most things in economics, it's because of the Great Depression. That's the answer to a lot of questions. First of all, the banks want to make money. They're not charities, so they need to be able to loan out money and charge people interest. So anytime you deposit the money, they keep a percentage in cash in the vault, and then they loan out the rest of the money that you deposited to other businesses or customers with interest, and that's how they make their profit. And historically, at the start of the Great Depression, we had some problems with things called bank runs, which you'll read about in just a day or two. But the idea was at the start of the Great Depression, everybody lost their confidence in the economy, ran to the banks and said, "We want all of our money, we want all of our cash, please give it to us." However, only the first couple of people or maybe a couple dozen people in line at each bank got all of their money because there was no fraction or percentage held onto by the banks. So if you were late and you didn't hear the news and you showed up a couple hours after everybody else, the bank might have just said, "Sorry, we don't have any of your money left and we can't give it to you," and then close the door because they didn't want you to hit them. So we have fractional reserve banking as a kind of stopgap to hopefully help in the case of another severe economic problem like that. Plus, your deposits are insured by the federal government, so we're a lot more protected right now. But also, fractional reserve banking can help the economy expand because the money that the banks are loaning out are used by consumers to spend money. You hopefully get a loan to spend money, not just keep it, because that'd be weird. And businesses get loans in order to purchase capital goods. Businesses go to banks to get loans for machines, buying new land, technology, factories, tools, things like that, which helps us long run with our economy in terms of growth. So more money in circulation means more spending and economic expansion. So this next slide is a huge idea. Like it says, there's not enough Dorito bags I could put on the screen to make you think that this is important enough. So the required reserve ratio, that's the actual percentage of each deposit that the customers put into the bank that the bank must hold on to. Again, the bank has to hold on to that dollar amount. Specifically, though, like it says right here, if the bank makes its own profits doing some sort of other transaction, if it's the bank's own money, they don't have to keep any money in there. The required reserve ratio only applies to customer deposits. And on the test, you might see some weird terminology because you just call it a deposit. They might call it demand deposits, checking deposits, or checkable deposits. But the one common thing there is that they all say deposit in there. So relating to the required reserve ratio, the total reserves are all of the reserves that a bank can hold. The required reserves, which we'll get to in a second, and the excess, the extra that their banks are not required to hold on to that they can loan out. So basically, if you deposit $1,000 into the bank's total reserves increase by $1,000. And then we kind of break it up after that once we see what the required reserve ratio is. So the required reserves are based on this percentage. So if you deposited $1,000, whatever this percentage is, we find out the dollar amount, and that is the required reserves. Anything left over after we hold out the required money is called excess. Excess reserves are what the bank can loan out. It is completely legal for them to loan out your money to other people because if you come and say, "I want my $1,000," they've got a portion of yours, but they've also got a portion of everybody else's money. So they'll just give you money essentially from other people that's in one common vault or one common pot within the bank. So before we move on too far, we want to make sure we can get 10% of a number and 20% of a number. Very rarely they'll ask you to figure out what is 15% of a number, but 10 and 20% are the most common. So if total reserves in a bank are $100 and the required reserves set by that big ominous building in the beginning, the Federal Reserve, are 20%, the first thing that we always want to do is figure out, based on the given information, what are the required reserves and what are the excess reserves. So if we're given $100, the required reserves are 20% of $100. Now I know we can all get 10% of a number, because to get 10% of a number, just take off a zero. So 10% of $100 is $10. Now, we were asked about 20%, not 10%. So the way you can think about it is, well, 10% plus 10% is 20%. So if 10% of $100 is $10, $10 plus $10 gives us 20% of 100. So the required reserves would be $20, and anything left over beyond that is what we call the excess reserves, in this case, $80, just some basic subtraction there. That $80 is what the bank can loan out. Those are the excess reserves. $20 cannot be loaned out. Those are the required reserves. It is a legal requirement set by the Federal Reserve. So again, this is just a quick breakdown of how to get 20% of a number. If you're familiar with that, you can move on. Otherwise, you might want to pause it and take a look from top to bottom, see how I got 20% of, in this case, $1,000. What you can also do is just turn 20% into a decimal, which is 0.2, and just do long multiplication. 1,000 times 0.2, all your zeros, move the decimal, and you're good. If you need help with that, come and see me. So how do bank deposits actually work? Clearly, this is you, accurate representation. You're depositing $1,000 into, clearly, this building right here is a bank. Very good detail. Up here, this is almost always given to us. So the question would tell us that the required reserve is 10%. Now, the first thing we always do is figure out what are the required reserves and then what are the excess reserves. So you're dropping off $1,000 into the bank. The first thing we know is that the bank's total reserves increased by $1,000. You brought $1,000 in. Now it's the bank's job to determine how much can they loan out, how much do they have to keep. So we start with the required reserves. Again, 10% is our required reserve set by the Federal Reserve. So we need to figure out what's 10% of $1,000. Easiest way to do that, just take off a zero. So 10% of $1,000 is $100. So as of now, we know total reserves of the bank increased by 1,000. The required reserve is 10%. So the bank must keep, very clearly here in this box, very strong vault, $100. That's our first step. The bank cannot touch this, cannot loan out this money. Now the next step is figuring out the excess reserves. And that's easy. If we put in $1,000 and the bank has to loan out $100, then anything that's left over is the excess reserves that the banks can loan out. So here we have $900. Nothing crazy, just basic subtraction. Now, sometimes we can stop there. We'll get to that in just a minute or two, but ignore this. You'll see that in class, the bank on the whiteboard. The idea here is if the bank loans out or is able to loan out $900, they will. So the bank decides, okay, a customer came in and that customer wanted to get a car. The bank gives that person the $900 that they're allowed to loan out. So the person who got the money goes and buys the car from a car dealership. Now the dealership has $900. And because we live in a modern society, most people keep their money in a bank. So the dealership takes the $900 from the person who bought the car and puts that $900 in the bank. And our whole process repeats again. When $900 comes into the bank has to keep 10%, which is $90, and then it can loan out the rest, 90%, which 900 minus 90 is $810. And we can keep doing this until essentially there's no money left. But we don't want to take all of those days of our lives. So what we do is we have something called the Money Multiplier. It's the exact same idea as the spending and tax multiplier that we saw before. An initial deposit by a customer multiplies or ripples out to have much more of an effect beyond just that initial $1,000 deposit. So in order to figure out what is the either change in the money supply or how much new money is created, those are kind of the trigger words in a multiple choice or FRQ type question, we use the money multiplier. So if we see that a customer drops in $1,000, like our initial scenario, and the required reserves are 10%, we use this formula right here. 1 over the triple R, we want to express that as a decimal, not as a percentage, so don't just put 10. 10% is 0.1. So 1 over the required reserve ratio as a decimal times the excess reserves. Now it's times the excess reserves because that's what the bank is able to loan out when a customer initially deposits that $1,000. So how do we do that? There's our formula kind of written out a little bit easier to read kind of way. These are the key words over here. Ignore the C, that's a little typo. Those are the two kind of trigger scenarios of when should you use the money multiplier formula itself, which is over here on the left. So in our scenario, somebody deposited $1,000. The reason I don't have all this math over here is because we had it back on the slides with the house. So you can pause and go back if you need to. If the question is, how much does the money supply change by when a customer deposits $1,000 into a bank? Since it asked us the change in money supply, we use the money multiplier. The required reserve was 10%, which as a decimal is 0.1, as we can see over here. So 1 over 0.1 times what we found to be $900. That's the excess reserve. The bank had to keep $100 in the vault. So 1 over 0.1, basically how many times does 10 cents go into a dollar? 10 times $900. If you need to do the long multiplication, you can. Otherwise, just add a 0. That gives us $9,000. So what that means is as a result of the customer depositing $1,000 into the bank, $9,000 worth of quote unquote new money was created because when you deposited 1,000, the bank loaned out 900. Somebody used that loan to buy something, so that 900 went into another bank, 10% was kept, and on and on and on. Other banks keep loaning money out. So essentially there was a $9,000 ripple effect as a result of that original $1,000 deposit. So again, this number 2 right here is what you want to pay attention to when it's asking about money supply or new money created, the money multiplier that we just went over. We'll get up to this top part, number 1, in just a minute. So there's 3 types of questions that can be asked and are sort of most frequently asked about in terms of fractional reserve banking. Total freebie if they ask you just in a multiple choice, what is fractional reserve banking? Percentage kept by the banks. But here are the 3. You can read them. I'm not going to read them verbatim. Basically, the first one, they'll could ask you about how many new loans can the bank put out. Then they could ask you about an increase in the money supply or new money, which we just did, which is by far the most common. Bless you, Mrs. Flanagan. And number 3, they could ask you about how much is the bank holding on to in excess reserves. And you can read that bottom part down there before we get to it. So the first type, if they're asking you basically a customer deposits some money, how much new loans can be created by the bank? The first step with anything on this topic is to figure out the required reserves and the excess reserves first. So here's our scenario. Joey deposits $10,000 cash into his checking account. The required reserve is 15%. What is the amount of new loans that can be loaned out or can be created, as a result of this deposit? So the first thing we need to do is figure out the required reserves and the total reserves, which we actually know the total reserves are $10,000. So $10,000 went into the bank, total reserves increased by 10,000. Now we need to split it up into required and excess. So don't freak out at 15%. Bare minimum, what you can do is 10,000 times 0.15. That's the easiest way to do it at this point. If you need help with that, come on in and see me. So if we do 10,000 times 0.15, that gives us the required reserves of $1,500. The bank cannot loan out $1,500. Whatever's left over, basically 10,000 minus 1,500, which is $8,500, that is the excess reserves. So if the question was, what is the amount of new loans that are created because of that deposit? You stop right here. Banks cannot loan out 1,500, so that doesn't apply. They can loan out 8,500. That is your answer, because the new loans that can be created as a result of a $10,000 deposit are $8,500 worth of loans, because the bank must hold on to $1,500. You stop there, that's your answer. The second type of question that can be asked is about new money or the increase in money supply. We basically did that question where the $1,000 deposit turns into $9,000. So this one, I think this should be 20% here, because we would never ask you to do 1 over 0.15. So here's a more accurate number right here. We're using 20%. That's just a typo on my part, and I don't want to stop this and go all the way back. TBRH. So Joey deposits 10 grand into his bank account. The required reserve is 20%. What is the amount of new loans that can be created as a result of the deposit? So if this was just a new loans question, what's going to happen is we find 20% of $10,000, which again, if you're having trouble with that, easiest way, 10,000 times 0.2. Required reserves of the bank must hold on to 2,000. Everything that's left over, the 8,000, can be loaned out by the bank. So the new loans that were created as a result of that deposit are $8,000. But our question, I forgot to change it up here, is basically how much new money can be created. So swap out loans right here for how much new money can be created. We just do the money multiplier, 1 over the required reserve ratio as a decimal times the excess reserves. So 20% as a decimal is 0.1. So 1 divided by 0.2 times $8,000 from this last slide back here. 5 times $8,000 gives us $40,000. That means as a result of a $10,000 deposit by a customer into a bank, $40,000 of new money, or there was a $40,000 increase in the money supply as a result of that initial deposit, because banks keep loaning out and customers keep depositing, and it's a cycle and a cycle. It gets us $40,000 worth of new money activity. The last type of question, this is extremely rare, pops up very rarely on multiple choice. It might ask you basically how much extra reserves are the banks holding on to. So they're required to hold on to a certain amount. How much beyond that requirement are they holding on to instead of loaning? Now, some people always ask, well, why would they do that? In the real world, they really don't. They actually really try to push the buttons and loan out more than they should be. So this is more of a hypothetical or theoretical kind of question. So this one, if the bank has $800 million in deposits, that's their total reserves, and they're keeping $100 million in reserves. That's what we're given. They then tell us that the reserve requirement is 10%, and it's asking us, what are the bank's extra excess reserves? So the question is asking, how much extra money is the bank holding on to beyond that 10% reserve requirement? So the first thing we do is we want to figure out, well, if they're required to hold on to 10%, what's 10% of 800 million? Well, 10% of 800 million, again, you could just do canceling a zero here because it's 10%. 10% of 800 million is $80 million. So we know that the bank only has to keep $80 million, but they are holding on to $100 million. So just again, some basic subtraction. What that means is the bank is holding on to $20 million extra than they need to. Now, generally, banks really would not do this because they exist to make money. So they wouldn't hold on to that extra, but they could. It's sort of a hypothetical scenario. So the answer to this question is $20 million. The bank could be loaning out that $20 million, but for whatever reason, they are not. So this is a big slide here. We'll get to a little bit more in class, especially when we get to FRQs. When you see the term bonds, bonds are basically the federal government asking for a loan. You buy a bond, so you give the federal government cash or money, and they give you a piece of paper, an IOU, that says, we'll pay you back in however many years you sign up for with interest. But until then, you can't ask for your money back. This is called open market operations. This is a huge idea, or really our second major idea. required reserve ratio, and open market operations. So again, this ominous sort of Fed, that picture from the beginning, they're in charge of this. The key thing here is if you see a question and it says the Federal Reserve buys bonds from the public, meaning the people deposit that money into their bank. So if customers deposit money into a bank because the Federal Reserve bought their bonds, if they buy something from you, that piece of paper, they're taking the bond and giving you cash. So you would deposit that cash into a bank. Since a customer deposited it, the bank must hold on to, usually 10 or 20% of that. The key difference though, sometimes the question, super bold down here, the Federal Reserve can buy bonds from the banks. The banks can also loan the federal government money in that kind of weird sense. Now, since the Federal Reserve is buying a bond from the bank, they are taking the bond from the bank, taking that essentially contract, and giving the bank cash. Now, again, the bank can do whatever they want with that money because it did not come from a customer. That is a huge, huge difference. If the Fed buys bonds from the public, the bank has to keep required reserves. If the Fed buys bonds from banks down here, that is pure profit, money going directly to the bank, not to a consumer. So the banks could loan out all of that money. They do not have to keep that required reserve ratio. So here's it kind of spelled out a little bit. If the Fed, quote unquote, which we'll call them, buys bonds from the public, you, me, people, we do it exactly like we did over here. We can only multiply by the excess reserves because the bank is required to keep a percentage of a customer's deposit. Keyword there being public, the customers. However, if the Fed buys bonds from the bank does not have to keep any required reserves. So what you would do is almost the same. 1 over the required reserve ratio times just the total dollar amount of bonds being purchased. Why don't we have to take off a percentage, Mr. Flanagan? Again, because the money is going directly to the bank. It is not coming from a customer. Essentially, the rule is we want to protect customers. Banks, if you want to loan out all the money that you make and take that risk, it's completely up to you. So these are the major ideas for fractional reserve banking, the money multiplier, the 3 types of reserves, and that Federal Reserve that we'll get to in a little bit. Down at the bottom, less frequent, but still pop up, M1 and M2 money, fiat versus commodity money, and the 3 functions of money. These really are the major ideas that you want to focus on, and we're going to spend most of our time in class on the top 3 in the bold up here. So if you have any questions, as always, come and see me. Otherwise, pause, go back, take a look at something if it didn't make sense. Check out Mr. Clifford, the AC/DC Econ guy on YouTube, and I'll see you next time.